For the bread earner of a family, be it a man or a woman, fulfilling the needs and wants of the family members is the topmost priority. During our life, as our family grows and the liabilities increase, we need more and more money to fulfill our family's need and meet the obligations. The bread earner of the family usually takes all the financial responsibility on his shoulders. But what if there is an unfortunate event of an untimely demise or an accidental disability making him unable to work? All the financial burden would fall upon the family members who might not have ever been prepared to face such kind of a situation. And this is where life insurance comes into play. It is an awesome product that helps you to safeguard your family from financial obligations and help them to sustain a reasonable life even after your untimely demise or a physical disability. In this video, we will discuss specifically about term insurance policy. We will also try to answer some of the most commonly asked questions such as what is the right age to have a term insurance policy? How much cover should you aim to take? What are some of the major benefits of having a term insurance policy? And lastly, what are some of the key factors that you need to look into before choosing a term insurance? Hi everyone, my name is Harsh Srivastav. I'm an ex-investment banker, a business owner, and a finance specialist. If you're new here, do smash that subscribe button and click on the bell icon so you don't miss out on any of my future videos. So let's get started with the video. A term insurance is a life insurance product wherein the person who buys the policy from an insurance company gets covered for a certain amount of money for a specific period of time. The amount covered under the policy is called the sum assured, and it is paid to the nominee of the policy holder in the case of an untimely demise. In most cases, the nominee who receives the death benefit is the spouse, the parents, or the children. To buy a term insurance, you can choose to pay the premium of the policy monthly, quarterly, half-yearly, or annually. However, in the case that you are an individual who does not have any dependents such as parents, spouse, or children, then in that case, you need not worry about life insurance. Now, term insurance can be bought between the age of 18 to 65. However, the amount of money that you need to pay to the insurance company, that is, the premium of the policy, is really high in your 50s and 60s. However, it is quite low in your 20s and 30s. So ideally, you should be buying an insurance as soon as possible. Also, the sum assured is connected to your income. The insurance companies allow the sum assured to be a multiple of your income. Between the age of 18 to 35, you can get a life cover of 25 times your annual income. So if you are in your early 20s and you feel that you can double or triple your income by the late 20s or early 30s, then that would be the right time to buy an insurance policy so that you can get a higher sum assured for an affordable premium. Let's say Neha is 25 right now and she has an income of 5 lakh rupees. Now, if she expects her income to increase to 10 lakh rupees by the age she turns 30, then in that case, 5 years later, she will be able to get a life cover of 2.5 crores as opposed to the 1.25 crore today. So it is better for her to wait for 5 years to buy a term insurance. Now let's talk about some benefits of term insurance. There is larger sum assured for an affordable premium. If you have ever tried to buy a life insurance through an insurance agent, you might have come across the term endowment policy. Unlike term insurance, where you do not get any sort of return on the premiums of the policy in the fortunate event of you not dying, an endowment policy will give you a payout in both the cases of maturity of the policy or an untimely demise. But the sum assured in case of endowment policy is much lower, and also if you ask the insurance agent what is the return that you're getting on the premiums, he would never tell you because it is embarrassingly low. Therefore, you must take life insurance just to secure your family's need in your non-presence and not at all take it as an investment. If you are wise enough, you would invest the difference in the premiums of a term insurance and that of an endowment policy in index funds or blue chip stocks. There are also income tax benefits. The premiums that you pay towards the term insurance are tax deductible under ATC. You can get a benefit of up to 1.5 lakhs. Also, the death benefit that the nominee receives is completely free of tax as per section 1010D of the Income Tax Act. The third benefit is the existence of multiple payout options. The term insurance usually pays a lump sum amount on the death of the policyholder. However, there are also certain policies that give you a monthly payout as well as a lump sum payout so that your family can manage their day-to-day expenses in a better manner. Now coming to the most important part of this video, let's discuss the factors that you need to look into before buying a term insurance. The claim settlement ratio is the percentage of claims that the insurance company settles out of the total claims received. So if there are two insurance companies X and Y with claim settlement ratios of 95% and 99% respectively, then in that case, insurance company Y is definitely better because it is settling 99 claims out of every 100 claims received, unlike the 95 claims in case of insurance company X. You can easily get the claim settlement ratio of insurance companies on their website. The amount settlement ratio is the percentage of total sum assured that is paid by the insurance company out of the total claims received. So if say an insurance company receives 100 crores worth of claims and it pays out 92 crores, in that case the amount settlement ratio would be 92%. Typically, the higher the amount settlement ratio, the better it is. You can get the data of amount settlement ratio from IRDAI's annual report, which is published every year. The solvency ratio indicates the total amount of capital that the company holds in relation to the total life cover that the company has insured. This ratio tells you about the company's ability to meet the claims received. Typically, in the insurance industry, a solvency ratio of 1.5 is considered to be good. You must also check the critical illness cover. A term insurance policy that has a critical illness cover is usually considered to be good. The reason being, critical illnesses are serious and often continue for a long period of time, thereby requiring a huge amount of money to be spent on medical treatment. The critical illnesses that are covered under term insurance are usually cancer, heart disease, paralysis, loss of limbs, etc. Lastly, you must also check the availability of additional riders. Riders are add-ons to your life insurance that provide additional coverage and protection against certain risks. These riders have an additional cost and therefore they increase the premium of the policy. However, the increase in the premium is completely okay for riders such as accidental death, permanent or temporary disability, and lastly, waiver of premium. The waiver of premiums is an important insurance clause because it enables the policyholder to not pay the premiums in case of critical illness, a serious injury, or physical impairment. So that was all about term insurance. Hope you now understand why you need one and how to choose the best term insurance for you. Thank you so much for watching. Hit that subscribe button and click on the bell icon and stay tuned for my next video.